who will be presenting pending sales, Mike Hughes, who will be presenting closed sales, inventory, and days on market, and Jeff Jones, who will be presenting closed sales. It is now my pleasure to begin today's presentation, starting with pending sales. Budge?
Thank you very much, Nick, and good afternoon, everybody. Thank you very much for joining us. Just to warn you in advance, we're looking at historical data. So if anybody expected a crystal ball as to what is coming ahead, you may be disappointed, but hopefully we'll be able to collectively arrive at some sense of the market and where it's coming in this year. I'm doing pendings, and just so everybody understands as well, pendings is simply not the total number of pendings within a given month, but the number of properties that actually go into pending status in a month. So it is consistent throughout the time. We all look at pendings, and I know everybody does, simply because that's the direction of the market, and that's kind of what we're putting in the pipeline for future closings and income. So those are the most meaningful statistics in some cases for us. And we know that when we're looking at full year 2022, that we're looking back on a year in which we faced a lot of headwinds based on the macro uncertainty, the doubling of interest rates, prices being up roughly 50% over 3 years. There were a lot of reasons why people elected to take a pause in the market after the crazy steroid years of 20 and 21, where we had really just an incredible market that we all knew was not necessarily going to be repeated. And now we're back to really trying to find out what the sense of normal is going forward. And we're all kind of in that boat doing it together. So the first thing we want to be able to look at is just the report in terms of the stats for, okay, I'm not getting movement on this. It is on. There you go. Thank you. I've got somebody who can advance for me. Love it. So if you look at it, what it shows is that pending sales for the full year in 2022 were off 35% against 2021, which is a pretty sizable margin, with the average number of homes under contract on a monthly basis falling from what was a peak of like 1,500 to roughly 1,000 units a month. I mean, it's still a lot of real estate, but we were used to something at such a fervid pace. Now, real estate is local, as we all know. So, we really only care about what happens within this market, but they're all interconnected. So I think it's helpful to have some context as to what's happening at a national level as well, because this wasn't simply related to Naples. It's what we really saw across the entire country. And it's not highlighted here, but I'll simply point it for those who can see. The 34.3% last year. This is the NAR pending index, which is only a sample, but it's still directionally accurate. And so what you find is that while Naples was off 35% in last year, we're seeing the country as a whole off 34%. So we're right in line with it. And it's amazing when you discuss with people around different areas of Florida, it wasn't as though any place was immune. We were all kind of following a fairly similar pattern as we went. Now, the good news is that if you look at some of the information from NAR, you see that the pending index that was released in December, actually was the first pickup. I'm sorry, I'm being told I need to get a little closer to the mic, which means I need to get shorter. Was the first pickup that we had in quite some time. So in December, the NAR pending home index went up 2.5%. That's one of the first indications that we had that we start to say, are we now at a point where we're approaching bottom, maybe coming off the bottom, starting to see a little bit of a turn in the level of activity? And I think one of the things that is always very helpful is to look at historical data, and hopefully these slides will be shared afterwards, because I don't expect everybody to be able to see what is on the screen here. But just for a little bit of historical context, what you see is that a lot of us begin comparing last year with prior years, not just the year before, but going back further based on the level of activity that we saw. And what you realize is that we were 35% off last year, but that ended up off of 2021, I should say, but that was 16% off where we were in 2020 and 17% off where we are, 17% above where we were in 2019. So in essence, when you look at the full year level of pendings, it was actually above 2019. But if you look a little deeper into the numbers, the trend was fairly startling. And I know it's what was seen on a national level because the first part of the year was very different from the second half. We know that we've had the consecutive months of declining activity on a national level. And so if for those who may be able to see it, you see in January of last year, we started off at a pace of pending contracts that was 100% above the level realized in 2019. But then as you move through the month, we see that we all of a sudden started to see that deterioration. And by May, we turned negative. There were a couple of positive months in there overall, but then we saw the further erosion. Now in November, we were 2% below 2019, but December 20% below on open business, which resulted in 17% for 2022 against 2020 on a full year basis. So again, the historical context, I think, is applicable because a lot of us are comparing where we are right now at levels of activity to 2019. We know the NAR sales pace was really most recently at a 2014 level. I'm trusting that no one expects that we're going to see that type of performance on a consistent basis. But again, there's other reasons to believe that we may be coming off the bottom. If you look at a graph, and this kind of speaks to the seasonality, this is just laid out, same data, but, and I won't go into, you can look at it later, but it just really speaks to the fact that we do have some seasonality in the market. Of course, one would expect there to be a variation, but a significant variation overall between years based on the timing between the first and second half. So it was fairly meaningful. So when you look at kind of where everybody's kind of looking at this and saying, well, what does that mean? Where are we at right now? One of the things that we all look at is this relationship between pending sales and closed sales, just in terms of where they are in the status. And if you look at the December report, what you find, and this is one of the first months, and hopefully this will be a consistent pattern, where we found that pending listings were off 34%, total sales were off 42%, which means that the level of activity that we're seeing is more positive than the number of closings that we're recently witnessing, which is another indication that we may be coming off the bottom. We know that nationally there's been a lot of uptick in terms of activity, mortgage applications in January. So I think we're all, again, don't have the crystal ball, but we believe that 2023 represents another great opportunity. Keep in mind, just in terms of our industry, because what matters to us is volume and commissions. Not from a public perspective, of course, but from our perspective, it does. So if we end up somewhere in the area of 2019 in units, but remember, we're doing it at 2022 prices, which are up 50%. So even if that occurs and we don't move beyond to a faster pace, it would still represent, this year would still represent one of the greatest volume years that we've had in this market or the industry. So overall, I think it's good news, especially what we're seeing in the last couple of weeks. Thank you very much.
Next presentation will be closed sales with Mike Hughes. Mike?
I'm going to probably talk about this in my text here, but let's with the pointer point out a couple things. If you look at this, you can see what Budge was referring to as far as closings, the drop off from 2021 to 2022. And you've got 10,156 closed sales. But what's very interesting is looking over the 19. It's pretty much the same number, but it's a very different story. And we're going to get into that story in a second. But the other thing I want to point out with this slide is that kind of year, 2021, is one of those rare years that pops up maybe every 8 to 10 years. You don't see that kind of year. Maybe 2005 would be another great year that we saw. That was when at the height of the bubble, et cetera. And there's always different circumstances that causes that kind of a year. So yeah, we've spent a lot of time this year comparing this year to last year, this year to the last normal pre-pandemic year. And I'm going to be doing the same thing because it's important to get some context here. And when we get into inventory, it becomes very fascinating. So that's the one slide we have. And one thing I want to point out, Adam Villano was supposed to do closed sales, and Adam's a bit under the weather right now. I want to give a shout out to him because he's probably watching from home. And Adam is a very valued member of the Media Relations Committee. He does a wonderful job with his analysis. So I'm strictly a pinch hitter for this particular area. But I wanted to thank Adam for all his contributions to our committee. Let's see if we have another slide here. Okay, overall closed sale. Now this is by quarter, comparing 2019's quarters to 2022. And you can see it's kind of up and down. Up in the first quarter, down in the second quarter, up in the third quarter, down in the fourth quarter. So that's one of those for whatever worth slides. Okay. Here's something that I find very interesting. If you look at what's going on here, the first half of the year, we were off to a great start. And then you get to the last 6 months and we kind of flatlined there. So you definitely can see a turn there. And there's some reasons for that. And we'll get into that in a second. But I mean, as Budge was saying with the pending sales, the first half of the year, when we were comparing this to 2019, we were thinking, wow, man, this is going to be another great year. And then we got into the summer months, and then for whatever reason, things started kind of, I won't say, it wasn't like it came to a stop or anything like that, but what it did remind me of is the old days. Because for the old timers, if John or Wood was around, John would say that, Mike, after Easter, you could pretty much close the office and go on vacation. And that's kind of how it was in the old days, but not anymore. I mean, really, we usually have a very good summer season, and then we have a fall season. We didn't really see that giant bump in the summer or the fall. We kind of were doing 500-600 units each month. So I think it's very interesting when you compare that to previous years. Now 2021, look at that, over 1,000 for the first 8 months, and almost the first 9 months. And then we hit it also in just, that was just a great year. So comparisons are a little bit unfair there. So let me read some of my text here. I also want to point out that in 2019, we had a quite different inventory level. So, the inventory really got knocked down in 2020 and 2021. So it was a different landscape in 2019 than what we had in 2020. If you look at it, and I'll pick up on some of my writings here, you will see in 2022, we had 10,033 closings compared to 10,301 in 2019. This represents a 2% drop in closings compared to what we did in 19. But as I said earlier, it doesn't tell the full story. In the first 6 months of 2022, our closings were up 15% in the first 6 months. In the last 6 months, we were down 22% compared to what we did in 2019, the last normal year. I almost hate to use that term normal. What is normal? But I mean, that's quite a swing. That's a 37% swing. So big difference between the first half versus the second half of the year. But let's think about that. What happened in the second half of the year? Well, you had rapidly rising interest rates. And those rapidly rising interest rates, and we briefly hit 7%, those higher rates caused not just some buyers to sit on the fence because they really had not digested that 7% rate. It also caused some sellers to sit tight, which kind of froze some listings because sellers were saying, yeah, I can cash out now, sell my property, make a nice profit. But if I'm going to finance my next purchase, am I really willing to go from that monthly payment I have at 3% and now pay 6 or 7%? So it kind of froze both groups there somewhat, not everybody. For us old timers, 7% is still not a bad rate. I mean, I remember the 18% rates. So, it's just, we got hit with things in the second half of the year. Wasn't just the interest rates. It was also inflation and all the negative media regarding inflation's going higher, higher, higher. And then in the middle of all that, we had a hurricane hit. And even though we didn't get the brunt of the wind down in the Naples area, we did see a historic surge that hit. I mean, the nearest we could compare it to was Donna back in 1960. So we had a lot to wrestle with in the second half of the year. The good news is those three items, interest rates, hurricane, rising inflation, that's kind of like the perfect storm. I can't see that storm hitting in 2023, not that set of variables. So I'm a little optimistic about this coming year. I mean, it's like any year, we're going to have some challenges, but I tend to be a little bit optimistic when I look what's I believe coming down the pike. Reading my notes here. Okay, so when we compared the closings of 2022 to 2021, okay, business was down. I think most of us kind of expected that. We did not expect to duplicate what we did in 2021. We had 10,156 closings in 2022. And 2021, we had 15,570. So, quite a change there. The quarterly comparisons, as we said, was a mixed bag. You saw that on the slide earlier. Interesting. In 2022, we had 4,999 single-family closings, and we almost had the exact same number in condo closings. We had 5,157. So, it's always interesting to see the mix between single-family and condos. So it's pretty evenly divided there. The December 2022 closings were down 42.3% from what we did in December of 2021. Frankly, December is always a month that I really look at. I'm trying to get a clue on what season is going to be like. And I was hoping for a better clue in December. But, it was off. You could argue what the reasons were. I think that January started a bit sluggish, but I think from what I'm hearing in the industry, a lot of us have seen an uptick in the last couple of weeks, which is encouraging. So that's pretty much what I have with closings. I mean, the beauty, if it wasn't for Budge's pending sales, I'd have nothing to talk about. So Budge, thank you for the pending sales. But most of the pending sales I find are closing. When we had that big downturn in 2006 and 7, we had a lot of people that were walking away from contracts and that kind of I'm not seeing that kind of thing now. So that's what I have with closings. I'll turn it back to you, Nick.
Next up will be closed prices with Jeff Jones.
Good afternoon, everyone. It's nice to see some familiar faces out there, and thanks for coming this afternoon. We're hoping to leave you with some pearls of wisdom about what's going on in the market. See if I can get that to move. Okay, so my job is to talk about closed prices, and we measure closed prices generally by the median. Okay, so just a little recap there. The median is the middle sale between, if we had 100 sales, number 50 would be the median. So I think we have to be a little bit careful in interpreting these numbers because closer to the microphone. Okay, I can do that. Thank you. Because we have to be careful because the change in volume and what went on especially in the last half of the year, might have made these price increases a little bit more significant looking than they really were on a neighborhood by neighborhood basis. So when we're referring to the overall median closed price, and we're looking at 30% overall, 23% in single family and 35% in condos, remember that's the middle price. And I'm going to show you a couple slides that the change in inventory at various price levels caused that median, I think, to go up quite a bit. The number of properties available in the under 400,000 market that used to be quite active is now pretty well dried up. So what happens is the pricing shifted up to higher priced homes, which forced the median up. But again, trying to compare year over year has a lot to do with the inventory mix. So I think we have to be a little bit careful. And that really, in a nutshell, is why you need a realtor, right? You're going to go into a neighborhood. You want to understand that neighborhood. You want to understand what's going on. Did the prices go up 34%? Probably not. Probably as we isolate and get down, we'll see that the good news is in our market versus the national news is we don't have a lot of supply. So we don't have a lot of downward pressure on pricing. Pricing seems to be holding up. Is it increasing at these rates? Probably this is a little bit due to the mix of inventory than it is to individual price comparisons. Taking a look at overall, we've now been tracking the average closed price for the past few years. We used to use all median. And again, the average is a little bit different, but it also is averaging higher price points and not having lower price points to moderate that average. We look at it on a neighborhood by neighborhood basis. You'll see actually in Naples Beach, 14%, but we see 20s across all of the other areas. Again, and as Budge pointed out to me a while back, he said, Jeff, some of this inventory buildup is because we don't have the volume of sales, right? So there's a combination of new listings coming on the market, but less sales than we've had. And we saw that in the second half of the year. Overall median closed price, again, that's for single family. This is for condos by that area. Again, keep in mind the product mix, keep in mind that individual neighborhoods are going to vary quite a bit. So I put this sheet in here to show you, and I'm not stealing Mike's thunder here, I promise, Mike. So, but to show you, there was an actual look at the rate of buildup in the higher price points versus down 13.9% in the lower price points. So there's your impact showing up in more properties being sold in the 500 to 1 million mark, more inventory available. And that's driving the median price up because there's no, it's occurring at the middle sale. The middle sale's at a higher price point. Okay. So that's an important point to notice how inventory built by price range. And a lot of this buildup was in the second half of the year. So I wanted to show you this because I think this is really important. Okay. The list to sell ratio for the year was quite impressive. In other words, we were realizing rates of sale very close to 100% for most of the year, almost all of 22 and up to the middle, or excuse me, 21 in the middle of 22. And then if you watch the graphs, then we started heading down because the market became a little tighter. And what I see a lot now are sellers giving not price concessions, but credits to help buy down interest rates, to help closing costs. And I tracked the last quarter here where you see we're up in the high 90s, as low as 98, down in the 2 million plus. At the end of the year, that number on the left was 96% and also 97, 97, and down to 96. So we started to see the list to sale price ratio come down in the second half of the year, meaning there's more room for negotiation and there's more ability for the seller to have some flexibility, not necessarily reflected in the final selling price, but reflected in some negotiated credits. So overall, is the market a little friendlier now? Yes, I think it is. And I think there's the opportunity to combat a little bit of the increase in rates by negotiating with your seller to have some credits at closing to help you to close. So I hope that gives you a little bit of insight. I think the raise in inventory and the raise in price ranges of that inventory are what gave us such high price increase numbers. But I also want to say that going into 23, starting in January, we see a little more flexibility in the market and a little bit more opportunity for buyers. So thank you.
Now we will have inventory and days on market presented by Mike Hughes.
Let's start off with days on market, if I can find that slide. Let's see. I don't think we need to get too complicated with days on market. There's a couple important points here that need to be made. First off, we've had 7 straight months of rising days on market, 7 straight months. So if you're looking for a trend, there's a trend. However, and it's a big however, if you look at 49 days, average days on market compared to the last normal year, 97, we're still halfway to where we used to really be. I mean, the days on market for many, many years seemed to hover between 100 and 120 days. That was normal. So even though it's rising 7 months in a row, it's still pretty low, you know, but it's certainly, as you're talking with sellers, it's certainly a point that can be made, is that, you know, the market has changed slightly, and the days on market is climbing. So, you know, depending on, you know, how fast they need that property sold, this, you know, might be something that you throw out there, that it is climbing. We don't know whether it'll continue to climb or whether it'll go in a different direction. We just don't know. The average days on market, if you look at it for single family homes, was up roughly, let's see what we have here. For single family homes, it was up roughly 3 weeks, 21 days. And the average days on market for condos was up roughly 2 weeks. So fairly close, but that's kind of what's happening there. It's I don't really spend a lot of time on average days on market these days, because the reality is it's still pretty good. We're moving property fairly quick, assuming that it's priced right. And that's where you guys come in, because a lot of times people trying to sell their home on their own, they don't know what's going on in the market. So pricing it right is very important these days. It's always been important. So now we're going to jump over to inventory, and let me see if I can find that slide. Okay, we'll go back. Okay, and I might have peeked at this earlier. All right, so here's what we have. You know, we've got inventory is going up. And if you get caught up in that, it's up 106%. And that really doesn't tell the story. I mean, it is climbing. That part's good. But it's a far cry from where we used to be. You go back to 2018, just over 6,300 properties for sale. It's funny. Now, I can remember in the Media Relations Committee, I'm guessing it was about 5 years ago, maybe no, a little further back. But I can remember at one point we got down to 4,000 units, and I was thinking, oh my God, what are we going to do? We're down to 4,000 units. So, and I don't know what number we had in 2005. That would be very interesting. The difference was in 2005, for those that were selling in 2005, the same property was selling 4, 5, 6 times in a year. That created our inventory. But we don't see that now. In fact, one of the encouraging things that we're seeing now is that we're selling to more end users. And so they're staying in there longer. And I think that's a positive, you know, for the area. Let me look at my notes. Well, let me see if we have any other inventory slides here. Yeah. Well, we'll stick with that one. That kind of that tells an awful lot right there. All right. So in going through my notes, overall inventory of homes for sale was up 106%, rounding it off there in 2022, compared to where we were at the end of the previous year. We had 2,465 homes for sale, compared to 1,195 at the end of 2021. of the 2,465 homes for sale, this one surprised me a little bit. 1,504 of them were single-family homes, and condos were only 961. I've seen a lot of years where it was the exact opposite. So for whatever reason, single-family homes, we have a lot more of that, and I like that because single-family homes are very popular to sell. So that mix did surprise me a little bit. The inventory of single-family homes is up 96.9% for the year, and condos is up 123% when compared to 2021. Giving this a little bit of historical perspective, I mean, if you look there at 2018, the 6,336, let's go back in time. Let's go back to March of 2007. In March of 2007, we had 12,440 properties for sale. And so what was going on back then? Back then, the real estate bubble had burst, so to speak, and there was a huge glut of inventory there. Demand was kind of rattled, and so demand was kind of soft. And I can remember in 2007 selling some condos cheaper than you could buy a used Lexus. I mean, that's amazing when you think about it. Now, anyone that was really smart back then and sharp would just bought up the whole thing. You know, really, there was a lot of money to be made there, but it's kind of tough to pull the trigger when people are spooked about what's going on in the economy and what's going on in real estate. So there certainly were a lot of buys back then. If we compare the inventory homes for sale at the end of 2022 to where we were 4 years ago, you will see that the supply of homes has dropped roughly 61%. That's a huge drop in inventory, and a lot of that was due to 2020 and 2021. At the end of 2018, Neighbor reported that there were 6,336 homes for sale. And then when you compare that to this year, you can see it's quite a change. As far as months supply of inventory, the month's supply of inventory, here's another trend. The month's supply of inventory has gone up for 4 straight months. So a little bit of a trend there. I expect when we get into the season and start having a bunch of those closings, that trend could stop, but we will see how that one plays out. We now have 2.9 months supply of inventory, where at the end of 2020, we had 3.1 months of inventory, so about the same where we were at the end of 2020. Part of the problem with the low total inventory sales for now is the new listings coming on the market. And that one is really bears watching. What we're seeing is that new listings coming on the market has declined 14% from where we were in 2018. 14%. Now, 14% might not sound like a lot, but that's 2,341 properties. That is a lot. So we have, less inventory right now. And it's one of the things as people, managing our various companies, it's one of the things that we look at day in and day out, trying to figure out, where is this bump in inventory going to come from? And if you look at the various sources, let's take a look at new construction. When the pandemic first hit, a lot of new construction slowed down. None of us were sure how that one was going to play out. I remember when the pandemic first started, wondering, wow, is this it? I mean, they were telling us don't go into the office, stay home, and you couldn't buy masks, you couldn't buy anything. And so who would have thought that we would have had that tremendous surge right after the pandemic hit? I mean, it's just an amazing story. But anyway, getting back to new construction, we know that it generally takes anywhere from 14 months to 2 years to get the product out of the ground to the point where it COs and you can sell it. So I think new construction is going to help us, but I don't see a huge bump immediately. This thing's going to take some time. Will it come from the storm surge properties that are coming back onto the market? It's going to help a little bit, but I would suspect a number of them are tied up with insurance claims and fixing them up and that kind of thing. So I mean, that's going to give us a little bit of a bump. Will the increase in inventory come from declining interest rates? That's an interesting one because we really don't know how many sellers have those low 3% loans and really want to sell, but they're trying to wait until the rates come down a bit. And that could be a real wild card. So I think interest rates, actually, if they go down, it might loosen up some inventory, and hopefully it does. Will the inventory come from plummeting property prices? Well, frankly, we're not seeing that. And when you look at how tight the inventory is, and the demand is strong enough to keep those prices up right now. I mean, you never know, things can change, but right now, we're seeing that the pricing is holding up pretty good. Will come from investor properties. You think about what investors did. A lot of them swooped in, bought a bunch of properties at the right price, many of them, and they turned them into rentals. Well, think about what's happening with rental rates right now. They're, I don't want to say sky high, but they're up there. Let's face it, they're high. And so when investors are getting these kind of returns on their rentals, I find it hard to believe that the investors are largely going to bail out on their properties and give us that inventory. So, I mean, the point I'm trying to make is there's a lot of different sources for adding to our inventory, but it's a challenge. You know, we're going to have to see how it all plays out. The one thing that I've noticed over the years, and I've been doing this for 23 years, the things that drastically change a market usually are things that you don't see coming, things that you couldn't anticipate. And think the pandemic. Yeah, right before March of 2020, we're hearing about some weird virus over in China, never dreaming that that would come over here and affect our market the way it did. Think about the BP oil spill. It didn't really hit us too bad here, except for rentals, but it certainly hit the panhandle in a big way. So those big things that can happen out there, I mean, those they do pop up. We don't know what they're going to be. The market ebbs and flows. So I just wanted you to think about that. The last point that I want to make about inventory, I did a study years ago, and I looked at the properties below 300,000. And what I found, and this floored me, I knew there was a lot of people that liked that low-end product. You had the first-time home buyers, you had the retirees on a fixed income, you had the workforce. The numbers I saw for sales in that low end were steady. It didn't matter whether you looked at March or September or June. It was pretty much a consistent provider of sales every month of the year. And you think about what we have right now, we barely have anything in that low end market. So that's part of the market that as collectively as a group that we don't have anymore. I mean, that buyer, if they're looking for something at 250, 200,000, whatever that number is, in all likelihood, they're going elsewhere because they can't find that here. So it's, you know, it's one of the things that does influence our inventory. So Nick, that's what I have.
We really appreciate the comprehensive and valuable information each panelist has presented to us today. I've prepared a few questions for our panelists to answer regarding trends in the real estate market. So I'm just going to go right down the line and have each of them provide an answer if they choose to. Bud, we'll start with you. And the first one is going to be, how did the hurricane affect the 2022 market?
Thanks, Dick. You know, the reality is that when you think back to it, this was such an incredible event. I mean, I'm a native Floridian, like many of you have been through lots of storms before. It was unlike anything ever witnessed. Like some of you as well, first floor gone, all bit. But when you think about the reality, it was really about 4 weeks of activity in the market that was, in my opinion, postponed because we recovered in terms of the pace of sales to what was actually normal for before that period of time almost immediately. And the biggest problem we had was overcoming the PR challenges of people thinking that Southwest Florida was wiped out when literally it was a matter of a few blocks that were impacted. And if everywhere else, you would never known that anything happened. So and when you looked at it, the impressive thing from my perspective is that other markets that didn't have the same level of impact, whether it be Sarasota, Tampa, their sales pace was actually off as much, if not more, than ours. So it wasn't as though we can point to the hurricane and suggest that that had any meaningful impact on our overall year because it didn't. So that's kind of what I see. I think as Mike had noted, there are some things that inventory that was taken off the market temporarily, condominiums that had whether association areas or elevators that didn't work. So some of that's going to be coming back on. That'll be helpful. We are seeing the lift from some of the storm surge as you related to listings, and some of the deals that have been flipped are rather sizable because it was all coastal property. So that element, I think we're going to see the full impact of that over time. But I'm just impressed that how quickly this market recovered and weathered through it.
You want me to say something?
No, we all do, yes.
There you go. Yeah, obviously I agree with everything Budge said. A couple other points that need to be made. One, the hurricane put tremendous pressure on our rental market. It was already tight. And so you had the people west of 41 that some of them were displaced and had to find something quick. So some of them took rentals in the area. But then you also had the people to the north of us that absolutely got slammed. And so you had Fort Myers people coming down here looking for anything that they could rent. You had people in the Estero looking. So the rental market certainly was impacted by Hurricane Ian. From an inventory standpoint, I know that I had to take some of my listings off the market, but then again, I got some listings from it. So I don't know what the net number, how that really played out, but my sense is that it removed some inventory, but then again, it put other inventory on the market. The one thing about a hurricane, and we all hate them, but it does hit at the right time of year. I mean, if a hurricane hit in March, you can imagine the impact that would have. But when it hits in September, and most of them seem to hit August or September, we're a little lucky with that one.
That's called optimism right there.
The other thing that, and this is important, it did bring out the scam artists. You're seeing a lot of that right now. You're seeing a lot of fake sellers, particularly with lots. And so these scam artists are getting very good with their documentation. In all my years, and Budge has been doing this even longer than me, I have never seen that kind of a scam where you had fake sellers literally calling you up, and they know that everyone here is hungry for a new listing. And so the flags are there. Normally they price it low, so that's a real deal. They tell you they really want a quick closing. You never meet them. I mean, this is all done electronically through emails, texts, et cetera. But it's scary. And that I did notice after the hurricane, they always take advantage of a disaster. I did see an uptick in that. So that's what I have, Nick.
Good. Thanks, Mike. Jeff, I know it's fun going last.
It's tough to follow these two guys, but I'll do my best. So one of the things that I noticed was the word surge is now a real word in our vocabulary. Many people said, oh, I was here for Irma. I saw the surge. It didn't bother me. But now I think the next time we have any type of a surge warning, people will heed it. They saw what really it does. Obviously, we had a king tide on top of the right wind and everything, but still the idea of flooding and surge has not been something we've lived with in past storms. The thing that overrode everything that I experienced was the resiliency of the people. Fifth Avenue was literally destroyed, and there were restaurants open a couple of weeks later And Fifth Avenue, a month later, looked like Fifth Avenue before the storm. So the amount of effort and resiliency and the spirit in this community was something that I noted. And for the most part, as both Budge and Mike have said, our market west of 41 wasn't particularly impacted by that. And as a matter of fact, I looked at the number of new listings and pendings and everything actually were up a month after the hurricane from what they were a few days before the hurricane. So the market did its job. It reacted. It took care of a lot of needs for rentals. It took care of a lot of needs for people that were displaced. But overall, the resiliency in this community was 100%.
Good. Thank you all. Jeff, I'll have you go first on this one. If you can pull the microphone towards you a little bit for me. Where did the bulk of real estate activity take place during 2022?
I think the first thing that comes to mind is there was a huge demand for single family homes. Microphone closer.
There you go.
Okay. I think there was a huge rush to single family homes out of the pandemic. And we saw that a lot of the single family home inventory went to near zero. And we saw a lot of condos. We saw a switch to the purchase of a lot of condos. So we went back, as Mike pointed out, to a balanced kind of a balanced market at the end of 22. So that was the first thing that I saw. Go ahead, Mike. Good.
I didn't really have a good answer for this one, to be honest. I mean, it seemed like the sales were all over. But yeah, the one area I've been noticing or taking note of is what's happening out in Golden Gate Estates and out there towards Ave Maria. Obviously, that area is changing. It's interesting to see how many new homes are going up out there. And it's fascinating to me that literally we have Floridians on the East Coast that are buying out there towards Ave Maria and commuting. I mean, I would have never guessed that in a million years. But, it's, they don't hit a lot of traffic going across. And then, you know what the traffic's like over there during their rush hour. So that's an area that I kind of know. I have horses, so acreage to me, I always kind of take a look at what's going on with acreage, but that's an area that I've been watching.
Good. Thanks, Mike. Budge.
Don't have a lot to add beyond what these gentlemen said. Really, I mean, we saw, and they've all spoken to it, the virtual elimination of inventory under 300,000. So when you look at the shift of percentage of where the sales occurred in terms of price stratification, everything went higher. 500,000 to $1 million became really the reality for the market. The thing that I think stands out for me is when you look at the single family price home average in 2022 topped $1 million in the market. And think back a few years and everybody would have thought that was virtually impossible to be an average for the entire market. And that is what is driving the move east in terms of the expansion of Maria and Immokalee and a lot of other areas that are now pulling sales away because that's the only place where there is the affordability that remains. So it's great that we, at least to Mike's point, we have that level of new construction activity. We need far more of it because we need that balance of inventory in the marketplace, or else we become a market where people simply can't afford to live and they can't afford to support the community. So we need to support everything we can to drive that.
Good. Thank you. Mike, we'll start with you on this one. The third one, what stood out in the housing market for 2022 to you?
Well, there was a number of things. First off, the high rental rates. The high rental rates are very tough on people that are struggling to save for that initial deposit to buy a home. And it just seems like they're in a tough spot right now. The price, we saw over a 2-year period, the pricing kept getting higher and higher and higher. And you look at the percentage of how much the properties have gone up in value. I sensed that when we got towards the tail end of 2021, it was starting to slow down a bit. Still a very good year. Very good year for what your properties were worth at the end of the year. Most of the year, it was largely cash buyers. You think about it, a lot of the mortgage people were not winning out against cash offers. And it's a tough battle. But most of the year, I saw heavy cash all the way up almost to the end of the year. The international buyers are largely back, but it's very interesting to see where they're coming from. More and more, we're looking south of us, not across the Atlantic. You look at Venezuela, Brazil, Colombia, a lot of them used to gravitate towards the east coast of Florida. Now we've been discovered, and they like what they see on the west coast of Florida. And also by the end of 2022, seeing a lot less bidding wars and multiple offers.
Great. Thank you. Jeff, go ahead.
I think one of the things that stood out for me was when the mortgage rates doubled, everybody said, oh, this is horrific. But what we realized were a lot of these rates were artificially low because the government was buying mortgage-backed securities to keep the rates low. All of a sudden now that started weaving into the economy and inflation. Will we ever see rates of 2 and 3 again? The mortgage people say, no, the investors have to make some money. They couldn't make any money at those rates. So will we see them go back to 5 or high 4s? Possibly. But I think we had to deal with the reality of rates. They were artificially low and they fueled the market, but they also, I think, ultimately created a situation. And my question to you guys is, did we borrow from the future a little bit? Did we realize in the second half of 22 that the pandemic we dealt terrifically with it? People were vaccinated. Now, all of a sudden, the frenetic pace of I've got to buy something now. And I'm not ready to buy for a couple of years, but I'm going to buy something now. So I think the combination of the rates and the combination of the peak of the pandemic created the market we have today. And I'm not sure that that's an unhealthy market. It's just quite a bit different than what we had before.
Thank you, Jeff. Budge, what stood out to you?
I think these gentlemen nailed it. I don't have a lot additional to say. I mean, I think Mike spoke to it even earlier about the significant difference between the first and the second half of the year. It was really a tale of two halves of the year. But all the things commented about the impact on the rental market and other aspects of it, I think were spot on.
Bud, you can keep the microphone on. We'll start with you I got one final question. What advice can you give to home buyers or sellers?
Well, you've heard the term a few times here about kind of searching for normal and what normal is. So I think a lot of it is we're beyond the pandemic buying surge and all the things that we experienced over the last couple of years. So now we're back to how real estate was done and the primary drivers of real estate in terms of population and demographics and job growth and all the other things. And that's where Florida, and particularly this area, we are so fortunate to have on a longer term basis, these fundamental drivers of real estate in our favor. So, that's very much a positive, but it is the fact that everybody's kind of seeking that new normal. We know from a standpoint of the sellers, from the seller and the buyer side, the seller's aspirational pricing is over. They can't count on getting 5%, 6%, 10% more than what their neighbor sold down the street 6 months ago. And we know in real estate, there's always a lag period in two ways. First of all, prices lag units. And if you go back to even like during, Mike spoke a lot about what we experienced during the Great Recession. But in Florida, prices took 18 months after units dropped to turn and start to head down. Now we saw it move much more rapidly today, but people need to realize that we're not through all that yet. And then your roles, a fundamental role that you play is trying to bring customers into reality in terms of bridging that gap because they don't understand the correlation. So sellers are having to be more realistic now. We know that the condition of the property, the ability to clear inspections, appraisals, these are all things that were almost kind of virtually absent during an 18-month period that are now becoming reality again. So, so it is the fact that we have to not only kind of get ourselves into back to normal realtor mode, but we have to get our customers to do that as well. On the buying side, we've had several months of slightly lower prices. We know we peaked a few months ago, both locally and nationally. But as was stated by others, there's nothing that suggests based on inventory levels, overall level of demand, that we're going to see any significant deterioration in prices. So, you know, the advice to buyers, of course, is if you think you're sitting at this out to be able to steal a property, you know, you need to go work with somebody else, because it's not going to happen. The prices aren't going to drop. And secondly, we still are in a sustained low inventory environment. It was noted. This is not something related to the last year or two. This is structural. This is something that, if you look back, we've been moving to lower levels of inventory consistently over the last few years. As far as new listings entering the market, people are staying in their homes longer. So they can expect more inventory to come on the market. And even within the limited inventory in the market, there's always two segments of inventory: those that have issues, that are overpriced, that are in poor condition, and those that actually have quality and well priced. So there is huge competition still for properties that are priced right and quality. So if people think they're going to sit on the sidelines for something better, they're mistaken. They should act.
Mike, what advice do you have?
Well, for the seller, and Budge hit part of what I was going to say, for those listing their property for sale, don't compare the price that you're listed at to what the neighbor got a year and a half ago in a multiple offer bidding war with escalation clauses everywhere. Compare it to what your other neighbor got 5 years ago, and you'll be very happy. So it's, I mean, really, if you get it right there at the top of the market, then you just got lucky with your time. It's sort of like when you sell stock. You know, if you sell it at the absolute high, you just got lucky with that one. But I also think sellers need to look much earlier about when their property does close, where are they going to go? In the old days, they could kind of make a last minute decision on that one. They could rent a place real quick and then look around, and try to find something to buy. But now you really have to think about that a little earlier in the process, because it's a different landscape. With respect to buyers, I'm concerned that a lot of buyers that are sitting on the fence because of the high rates are going to wait until, in their mind, rates get down into the 5s or possibly 4s. Think about what's going to happen. If there's a lot of people that are in that same mode, then when they all jump, all of a sudden inventory is going to go way down. And that guy that could have found what he wants right now is going to be looking and looking and look, what happened? Where did it all go? Because a lot of people, if he's looking, a lot of others are in the same boat. So really, if you see something you like now, I would consider, go making a move on that one. The other item is that I think the renters that are out there now that are looking to buy really should do your homework on down payment assistance programs that are out there. And our very own Kathleen Pasadomo is working on a piece of legislation right now that could be very interesting if it gets through up in Tallahassee. So that's the advice I have.
Perfect. Thank you, Jeff. Let you wrap it up.
Well, I'll try to follow all that. It was very, very wise information that was shared. To my advice for sellers or working with a seller, what's your motivation? Do you want to move closer to your family? Do you have long-term things you want to do? Because, you know, if you're sitting there saying, well, my neighbor got this 3 months ago, that may be completely against your motivation that you need to move or you want to move. And remember, the market you sell in is the market you buy in. So that seller that was looking for this high price, obviously, if they're turning around going to buy something, those prices have adjusted to more reality also. So I think working with the seller on their motivation, trying to help them achieve their goals, and reminding them that the market is a little different, even though they're thinking of what their neighbor got a few months ago, the market's different today, and they need to price it right if they want to sell it. My advice to buyers, I'm an insurance junkie. Really, if you are thinking about writing an offer for a buyer, you need to get the insurance information. Our insurance market in Florida is still very traumatic. The cost of insurance is still quite a bit higher than it is nationally, and it could affect the affordability of the property or the cost of ownership. So make sure you check the insurance situation out And if you can, assume the seller's flood policy. That can always save you money, because if there's going to be an increase, it can only be done at a certain rate. So check your insurance out before you write the contract, and I think your buyer will be a lot happier finding out what it's actually going to cost them to own the property. Thanks.
Great advice, all three of you. Jeff, that was actually really good on the insurance part too. It's real good stuff. That concludes the question and answer section of the conference. But before we end, I would like to give you all an important announcement, a save the date, if you will. The 2023 Economic Summit will be held on September 27th, and we are going to Arthrex this year. We expect to have a very interesting panel of expert national, state, and local economists. So be sure to put the Econ Summit in your calendar for September 27th. The 2022 year-end statistics, charts, and infographics will be released today and posted on nabor.com. And again, we will be posting this video from today's conference on nabor.com, which will include the slides. Feel free to share the information with your associates and your customers. Thank you all again. Thank you again to our panelists here today, as well as Mike mentioned, Adam Villano, who unfortunately is under the weather, but he was prepped and ready to go, and he's a great presenter all the time. So we missed him today, but good job, Mike, for filling in, and thank you for doing so on such short notice. Thank you to everyone here in person, as well as all those on Zoom. We hope you found this information valuable. Having a better picture of the current real estate market and its trends will be helpful as you prepare for the upcoming season. My sincere best wishes to all of you for a successful year ahead. Thank you.